So yes, we are able to get some kind of a step jump, but it is not as ideal as an advertising-driven model is, because an advertising-driven model, you straight away see benefit accruing right now to your bottom line. What happens with YouTube free service? Short format content, all the licensing to short format services is still a fixed fee deal, renewed on an annual basis.
Okay. My last question is on this line item unallocable expenditure. It's moved from 7 odd crores in FY23 to 74 crores in FY26. What are the components of this? Has there been any reclassification, and how do we think about growth in this expenditure over the next few years?
So I think my thing is, unfortunately, I don't have a CFO at this moment. Can I ensure right now somebody calls you up and takes you through these numbers in detail? Because you're quoting 23 to 26 moment now.
Yeah, I mean, every year it is doubled.
So we will go back and sit with you. See, the core part, I can go back and say that the core management team is all sitting in there. So there is some amount of manpower cost also that is sitting in. Kuldeep, do you have an answer to this, if you can help?
Sir?
From FY...
Moment, can you repeat your query? We just lost you in between.
Yeah. The unallocable expenditure, which comes below the segmental results, it moved from 7 crores in FY23 to 16 and 24 to 36 and 25 and 74 in FY26. Right? There's a 10x increase in that expenditure.
So if we have to look, if we see comparison between 25 and 26, so in FY26 it was 37 crores and it is now 73 crores. The major, because this unallocable expenses net of other income, which is the income which we do in investment in mutual funds and FDs. Now when we are investing in the content, we are realizing that those investments, and that is where the interest income has dropped. And as a result of the same, you are seeing that delta in this expense. This is one of the major reasons of increase in the expense, which you see here.
Okay, okay. Sorry, maybe I can.
So as the QIP funds are getting utilized, either in terms of purchases of earlier pocket aces, then happen Bansali and our newer music content that we are doing, the interest income on that capital is coming down, which means the netting of effect is coming down. So in reality, the unallocable expenses are not going up in any alarming fashion. It's just the netting of portion which is giving this illusion as if they're going up.
Okay. I mean, I think I need to take this offline, because between FY23 and FY26, other income has dropped only 10 crores, whereas this is gone by almost 70 crores. Yeah. Yeah. Okay, I'll take this offline. Thank you.
Sure.
Thank you. Our next question is from the line of Sanmat Jain from Kamayakya Wealth Management. Please go ahead.
Yeah, hi. Am I audible?
Yes, please.
Yeah, so I had a couple of questions. So I wanted to know about the revenue from social media platforms. So suppose an influencer posts a reel using our music. So what's the reel structure and how much do we make from that one reel? What's the revenue model there?
So I had answered this, I think, last question only. All our social media platform deals are flat fee deals. That means we get paid a flat fee by this platform for utilization of our music across reels or posts during the year. So you're not getting paid right now on a per reel basis, but this license is restricted only for individual consumption and usage. A brand cannot take advantage of this and post any reel of theirs. Brands have to negotiate a license from us directly.
Okay, understood. My other question was related to the investment part. Suppose we do 350 crores in FY27 to reach our stated target of 1,000 crores. But from FY28, what investment budget are we planning?
So we are looking at a linear increase as we people go forward from post FY27. Because principally we are comfortable that 25 to 30% market share that we will get with the 300 to 350 crore content investment. So as you go forward, you can look at anything in terms of very high single digit to a very low double digit percentage increase on year-on-year basis.
Okay. So, considering the base of 350 crores for FY27, so incremental to that you are saying, right? So suppose 400 crores kind of number.
Yeah. So see, for me, at this juncture, 12 months away, it's more of a philosophical question, and our philosophy is clear that we started from zero investment in this company on new music. We have ramped it up in a very rapid fashion over the last 3 years to give ourselves clear leadership position in multiple languages, to get ourselves a 25 to 30% ke beech ka market share on a pan-India basis in terms of new music. We are comfortable. We want to consolidate our position here. We don't want to go back and do another massive step function jump here.
Okay. Thank you. That's it from my side.
Thank you.
Thank you. Our next question is from the line of Rohan Nagpal with Helios Capital Management. Please go ahead.
Great. Thanks for taking my question. Am I audible?
Yes, please.
Yeah. This are the numbers. I just want to understand the seasonality that we see in the music revenues that we're booking even after taking out artist management. There seems to be a steady audience through the year. So what is the underlying driver of that increasing streaming or licensing revenue Q1 to Q4?
Sorry, I'm so sorry. You will have to repeat your question. Could not hear you. Hello?
Hello.
Sorry.
Hello.
Rohan, please go ahead with your question once again. Your audio wasn't clear earlier.
Okay. There's a clear sort of increasing trend between Q1 and Q4 on the music revenue that we generate, except Saregama and except artist management. So increasing licensing revenue. I want to understand what is the driver of this increasing revenue in licensing between Q1 and Q4 through the years.
So between Q1 and Q4, actually the biggest factor is which big album is getting released. A lot of this revenue that you are seeing right now is also governed by the new music releases. Typically in our country, Q1 being the IPL time, you will have less new big movies getting released during the year. Q3 being the Diwali time, ends up seeing a massive release in terms of new music, and then the December-January time frame is very, very big. One being Christmas, second being around Onam. Why am I saying Onam? Around 14th of January. The 14th January becomes a very big release date in South India, and then 14th February becomes a very big release date across the country as far romantic movies are concerned. So you typically in our country have bigger releases coming in Q3, Q4. The only date that stands out is around Onam wala date, which is from 15th August to end of the August, where you do have big Malayalam and sometimes patriotism-driven Hindi films also coming out. So that's a level of seasonality. You may have seen sometime that Q2 may become bigger than Q3 also, and we have seen that in the past happening with us. But Q1 typically is the most muted one because there are very few releases. The other factor which need to keep in mind for Q4 is that there are some of the commercial relationships where the money hits us only at the end of the year. This typically happens with various relationships we have with various societies. They are able to go out there and finish the reconciliation for the entire year and release the monies only. Typically, they do 2 or 3 tranches of payment, but if they're getting delayed, primarily all the payments end up hitting you on Q4. That's why, like a stuck record, I'll again be please look at us on a rolling 12-month basis.
Understood. That's really helpful. Thank you. And then the other question I had was there's a sharp decrease in the advertisement and sales promotion expenses here. Is that on account of events not being there this year, or not with the same intensity, or is there some other factor driving that?
Ali, two big factors start coming in here. One, you have nailed it. Last year, this also included all the advertising that we people had done for the Diljit Dosanjh show. Also, we have scaled down the video vertical this year. So very few new films were released by us this year, while 25 also had film advertising expenses sitting in. So this is not just music. Music, there isn't that much amount of change. There is some amount of reduction, because if you see the content investment that we have done during the year, which is a combination of content plus marketing or new music, has come down compared to the previous year. These movies like Paradise and Love and War, had they got released as earlier planned in February-March time frame, these expenses would have been a little higher.
Understood. And the last question, there's a sharp decrease in the content charging cost this quarter. Is that because there was the Durandar marketing spend that was incurred in Q3, which is not there in Q4, or is there some other
Please,
driver?
quarter on quarter becomes very tricky. When it goes up, we don't take, when the numbers move in our favor also, we don't take the credit on a quarter basis. Evaluate us on a 12-month basis, becomes that much easier.
Understood. Okay. Thank you.
अब कोई movie release हो रही है अगर 27th or December, now it will get the marketing का spread कैसे होगा उस पर depend करता है. Is it front loaded, is it back loaded, and everything changes. So and if the movie is getting released in December, was the last song also released in December? If the last song was also released, we will consider the entire content charge, otherwise the content charge moves to January. That's why it's always better to evaluate this thing on a 12-month basis.
Okay, fair enough. Understood. Thank you very much. Thank you.
Thank you. Our next question comes from the line of Manish Gupta from Equinox Investment Advisors. Please go ahead.
Thank you for taking my question. So, is the IPRS movement a threat to the revenues, especially after Calcutta High Court ruling in that Vodafone case?
It does not have any implication on us. I'll just leave it there.
Okay. And secondly, sir, I understand that market price of the stock is neither your focus, and it should not be, and not under your control. However, markets are said to be voting machines in the short run and weighing machines in the long term. Saregama has been on a downtrend for several quarters now, notwithstanding today, which we are grateful for. Is there anything fundamentally altered or disrupted in the music industry or Saregama's business which is causing this downtrend, in your opinion?
So I'll not comment, as you rightly said. I am not going to be commenting on the pricing, the P part of it. And the management team is fully accountable on the EPS part of it. All I can go back and say is Saregama 3 years back, when we decided to get into new music, we had made a statement at that particular time that we are preparing this company for 2050. This company had made a mistake in year 2000 by deciding not to invest in new music content. It's easy for us today, right, if we sit and say that the only thing we want to drive is profitability. All that board has to go back and decide is that from now onwards we will not invest in new content. If we do that, and it's a very conscious part that we want to drive only profitability from music today, growth and a long-term sustainability is not something that we want to drive. This company can become a 75% margin business tomorrow. Because there is, in music business, that's your beauty. There's very limited cost once you have already paid for the content that you have taken, and the music keeps on making money for you on a long-term basis. We took a conscious call, and that time also we had prepared the market saying the going has been great, but the going has been great only on the back of the catalog. We don't want a situation 20 years down the line that the kids of that time asked that who was Kishore Kumar or who was R.D. Burman. Because the Kishore Kumar what Kishore Kumar is for us today, 20 years down the line, Arijit will have. So we are just investing in newer content in an aggressive enough fashion. And when you invest so heavily in newer content, especially in a step function jump, in the short run, the increase in revenue will get matched completely by the charge off on content that you are taking. We are slowly getting out of that cycle now. So if you are congratulating us for the quarter 4 results. Believe you me, right now, the real game of this started 3 years ago. We are now slowly getting into a position where the benefits will start accruing to us.
Fantastic, sir. Fantastic. And my last question is that the new generation is now watching reels all the time. So does it or can it affect music revenues in coming times?
So, दो तीन चीजें. एक तो Saregama has owns 91% of Pocket Aces, which owns the biggest Gen Z channel जहाँ पे लोग reels देखते हैं. So Saregama also owns through Pocket Aces Filter Copy, which is the ultimate reels place for people under the age of 30. So I have a play there. Second, anybody else who is using a reel at any particular time, you'll realize majority of the reels, I don't remember the percentage, but bulk of the reels you will see on any of the social media will have music attached to it. So there is a monetization that ends up happening right now on the music side too. So for us, presence on social media, whether it's presence on social media, presence on a TV channel, presence on a digital series or a film, any time a video is seen, there is a high probability a music will get attached to it, which becomes another touch point for us to monetize. So we look at it, this expansion of reels with a lot of positivity.
Okay. Thank you very much, sir. Thank you.
Thank you. Our next question is from the line of Resham Jain from VVD Asset Managers. Please go ahead.
Yeah, hi. So I have just one question. If you can share the revenue from the content which has been bought over the last 5 years, if that number can be shared, because there is hardly any way you have this payback period in mind of 5 years, but for us, it's very difficult to assess how profitable it is. So if you can share at least the last 5-year cumulative revenue in this year, FY26, of the content bought, that will at least be helpful for us to evaluate.
So I'll tell you how you can arrive at this. If you check on my last corporate presentation, there we have shared data with you that how much revenue is, what percentage of the total revenue on the music side is coming actually from the music release after 2020. That data is as of FY25. Does not include the 26 data, and we will be releasing that part also shortly. But till 25, you will get that information. If I remember my numbers correctly, right, 40% of the total revenue that we people had is music released between 21 to 24. This is as of May 25 data.
Okay. So if I then look at the overall revenue, because now you have artist management and other things also, obviously music revenue also is separate, but then the CAGR growth of the old music, from, as you mentioned in your comments also, that it is inflation driven, how should then one look at that part? Because that seems to be growing much slower than maybe some of the other competitors.
So I disagree with that part. I am not going to talk about competitors, please. I'm talking about our absolute numbers here. The catalog growth that we people have seen for us on an apple-to-apple basis, what does mean is that I'm going to be comparing my catalog growth on Spotify in over the last 3 years, or a Savan over the last 3 years, or a YouTube over the last 3 years. We are growing at this juncture a bit higher than inflation also. And we are fairly confident this growth is going to get further accelerated as we go ahead. Let me take this opportunity to also share with you that we are now creating a newer experiment within the company, whereby we are saying that how can we use the capability of the generative AI to create enhanced content and properties around older music that we people have, which may be generative AI-driven music videos for a Hemant Kumar song or an S.T. Burman ka song, or it may be podcast which will be connected to the older songs that we people have, which gives us not only an opportunity to promote the older music, but also find a fresh way to monetize the older music. The problem is when you are going to be looking at my numbers, do keep in mind, the moment you do absolute catalog to absolute catalog, there's a decline because music had a decline, because we had platforms like Resso shutting down, we had platforms like Wink shutting down, we had Ghana going from a free to pay completely, we had Hangama shutting down. So overall numbers fell down in a dramatic enough fashion, which is the reason why you see music revenue growth except the last 2 quarters, were going on a more muted basis. But on an apple-to-apple comparison basis right now, the catalog is growing.
Okay, understood. Perfect. All the best, and really admirable the way you communicate and show the passion about your business. Thanks for that.
Thanks.
Thank you. Our next question is from the line of Sandeep Agarwal from Naredi Investment. Please go ahead.
Yeah. Thank you for the opportunity. I just don't, my question is this: our performance regarding the last 3 years. So our competitor company also have a market cap of 8,000 crore, approximately to ours, and we have same P37. There is a ROC is our company our competitor company ROC is 122, while our ROC is 17%. They said 1990 music revived their top line and bottom line, while we have more good library of music song, but we can't perform. Will you tell where we are weak? They have a 59 crore content cost last year, and we have approximately 235 crore. They write off content cost 100% on release itself. We are also a good property to monetize in Bandhan area. Still, we are far away from them. So just comment.
So I can talk only about myself. So if you have any question directly connected to Saregama, I'm happy to discuss. I'll not like to pass any comments on my competitor's business.
So this is hello. Hello.
Sandeep, you are audible.
We can hear you.
Go ahead.
Hello. So just
Sandeep, you can go ahead, please.
Yeah. So I just want to know that where we are. Just. So my question is regarding the performance of our company. Where why they are not performing?
Sir, I don't know how you're calling it not performing. The Indian music industry growth numbers have been published. This is a neutral study. None of us are involved in that part. ENY has gone out there and done it as part of FICCI report. IMI, which is the music industry's apex body, has gone back and published this. Both of them are saying music industry during the year grew up between 7 to 8. Somebody is saying 6, other is saying 8%. That's the industry growth rate. In that industry growth rate, the only reason Saregama has been able to grow faster because we aggressively bought newer content, and the fact that newer content has worked can be checked on YouTube, can be checked on Instagram, can be checked on Spotify, sir. You can go to various charts of Spotify, see that when I am saying my content has worked, there are third party which is saying that the content has gone out there and worked. So I know there's far better work we people can do, and we will try our very best to improve our numbers even further. But saying that our revenue is not growing or our strategy is not working will be a little unfair, sir. I don't know about competition. I know absolute numbers that are there in the market. And I also promise you and commit to you right now that the numbers in terms of profitability as we go forward with the strategic approach we took 3 years back, as we continue on that path, are going to become even better.
Just one more. Sir, the company has been an aggressive content investment cycle, 1,000 crore across financial year 25 to 27, which is very exciting. However, from the shareholder perspective, the ROE has been around 13% for the last 3 years. The stock has some correction. So could you management help us in the sense?
You will. When we people raised the QIP, it was with a very specific thing in mind, that we want to go out there and invest in content that will get us ready for future. The first strategic call we take right now, that the music has to be invested in. You are already seeing the results. We are growing far faster than the publicly acknowledged and published growth rate of the industry. Second, we took a call to go back and buy Pocket Aces. The fact that in last 2 years we have been able to go out there and turn around Pocket Aces and make it a huge marketing machine, and it's growing at a very fast pace. Third, we have taken a conscious call to go out there and invest in Bhansali Productions. This will ensure that in the days to come, the most valuable film albums that will be coming out in the market will automatically go to Saregama at a pre-agreed and negotiated price, so that I have some kind of a control on the cost escalation that may happen in a very, very competitive market. So the results of all these will start coming out. So the equity that was raised has been invested in these areas. And we are on the path finally to go back and increase the ROE. Are we happy with a 13.5% ROE? We are not, sir. But we know that journey has to be traversed through. And we are traveling on that journey, and hopefully we are taking care of the guardrails. We may make mistakes here and there, but the intent is very, very clear that in the end the ROE has to go up, because eventually shareholder value improvement is the final goal for everybody.
Thank you.
Thank you. Our next question comes from the line of Akshay Jugani with Exponent Tribe. Please go ahead.
Hi, Vikram. Thank you for the opportunity and congratulations on a good set of numbers. Am I audible?
Yes, please.
Yeah, perfect. Thank you. Vikram, a couple of questions. Like you mentioned that the headwind on the platforms shutting down or switching off free is sort of behind you. So over the next 1 to 2 years, as platforms sort of start pushing, and they have already started pushing premium, do you expect the growth rates to now sort of kind of mirror their growth rates, or do you think there are more changes within the industry structure that kind of are expected?
No. So one part is what I'm expecting. Second is the guidance I'm happy to give at this juncture, knowing the current situation. So in the current scenario, looking at the subscription growth rate that is happening for the music vertical of us, which for the sake of now added retail also to it, we are projecting a 20 to 23% CAGR over the next 3 to 5 years. But can this change dramatically into a hockey stick effect? It can. If anything is to go by, but look at the subscription data in other parts of the world. Even a Latin American country is sitting out there in 13 and 15%, which will be 5 times of what we people are today. And those numbers are not very difficult to achieve. All that 1 or 2 of the leading platforms have to go back and do is that they just shut the tap of the free content. They are all making the right noises. The subscription when it's going to take off, what I can promise you is the day subscription generally take off, we are not talking of double-digit growth there. You will see numbers going out there and literally doubling if needed be on a year-on-year basis for the first few years. It will be a hockey stick effect. But till the time it doesn't happen, I can't go back and give you a guidance on that.
Absolutely.
But we believe in that very strongly. We believe subscription story has played out in every part of the world. In India, it's playing out on the video side now. The T-Watch story is playing out on the gaming side in India now. So we understand that the younger generation is comfortable with the idea of paying for digital content. I am 50 plus. My age group has a serious problem paying for anything on digital. Even I start thinking, कोई free का तरीका निकल सकता है क्या? But the younger people don't think that way. They have not grown in the world of digital always being free, and they are comfortable paying for better experiences and not necessarily trying to find out an easy way out. But the fact of life is somebody has to shut the free supply and make pay on an affordable basis. India is not a $5 market. Any company that will try that is going to burn themselves here. India is a $1.5 kind of a market, but you can easily generate numbers of 100 million.
Sure. One of the things you spoke in this conversation earlier was that your at a directional level, your free part of the revenue within music has remained flattish, while a large part of growth has come from the paid part. I mean, right? Now, I understand that over the last 1.5 years, there has been CPM pressures. There has been, I think, YouTube algorithm changes, and YouTube itself has sort of not grown as much as they would have probably thought. At least our understanding is that. Is that something that you expect to change over the next year as well?
So when I gave you that number right here of free being flat, this was more for audio OTT than the video OTT.
Okay.
So YouTube for us has seen a growth. If that's the direct question on free and pay both. Remember, video OTT had its every year. There's some other or new pressure that starts coming up. I think the ban of real money games ended up taking a large revenue stream out of YouTube. But the good part for us is because the kind of content we are putting out is more film music, which is more family content that's going in. We, as a category, got affected less by the going out of RMG advertising money, and hence on YouTube we were able to show a healthy growth both on the free and the pay side. Actually,
sure.
I have heard this story of people saying that their numbers from video OTT are going down. Actually, that doesn't apply to us.
Okay, interesting. Sure, thank you, and best of luck for the coming years. Thank you.
Thank you. Ladies and gentlemen, we will take that as the last question for today. I would now like to hand the conference over to the management for closing comments.
Thank you, everyone. Many of you guys have complimented us on our Q4 results. Please remember, you're finally seeing the fruits of what was